Hey there, Bram Spiero here. You're watching Buy and Hold Fundamentals. Today, I thought I'd take a closer look at my deal analysis Excel and just show you how I use it and the way it's put together. I'm still trying to figure out how to continue with my multifamily analysis. So this will be a nice filler until I got that all sussed out. The main area that I use is what I call the analysis tab. That's where you enter all the pertinent details, and then some of the formulas I put in here will take care of the rest. And you get a slew of indicators which you can use to make your initial analysis. There's two basic type of fields. The ones that are in orange are input fields, meaning that you can change the values and those values will have effect on the rest of the sheet. And then there's the gray fields with the orange lettering, which are calculated fields. So they're conditional, whatever they have formulas behind them. You shouldn't enter any data there. They're just calculated. And in order to make things easy, I've entered a imaginary purchase price of 100,000, so you can sort of see the effects of everything. The down payment is a result of the percentage I put in here. Seeing as I am looking at mainly investment properties, I leave that at 25%. You might be able to get at 20%, but that's the first assumption that I make. The interest rate, I'm putting at 4.5% at the moment, and that affects your mortgage payments, as does the loan period. All of that information, meaning the finance amount, which is a result of the purchase price minus the down payment, which comes from the percentage here, the interest rate and the loan period in years gets fed into the loan amortization schedule. As you can see, all of that stuff's here. And then it goes ahead and calculates your monthly mortgage payment, which comes out at 380 in this case. And that goes back to the sheet and shows up here. What else you got? Closing cost is a function of the price. When it's below 400,000, it's 3% of the deal. When it's over 400,000, it reduces to 2%. I always assume that you're going to have some kind of improvement, so I put in $2,000 here. And in the end, that gives you your total cost for the deal as well as how much you're going to be paying at closing, which here is a combination of the 3,000 closing costs plus the 2,000 improvements. All right, having said all of that, that's sort of the acquisition cost breakdown. Now, the rest of the stuff comes in. So your gross scheduled income is your rent that goes in here. You enter monthly and you get the annual calculated. Vacancy rate, I'm really conservative, at least the first time I look at things, and I put in 10%. If you want to put in just a month, it's 8.3. There's people that are going to say that there is no vacancies in their area or it's much lower. You're better off starting by looking around and assuming a 10% vacancy or a month's vacancy or what have you, and then finding deals and figuring out that in the end you don't have any vacancies at all or it's much lower than this, then doing it the other way around. Anyway, that's the way I look at that. That's reduced from the gross scheduled income and comes down to what you're actually assuming you're going to bring in on an annual basis. So we started with 18,000, it's now down to 1620. Then you look at your operating expenses, which includes property taxes, insurance, HOAs, any utilities you'd be required to pay, landscaping or snow removal, any other annual payments, plus assumptions for costs such as property management, which even if you intend to do that yourself, you should figure the cost for that and not, I mean, that's, if you do it, that's your salary. Even if you pull that salary through cash flow, you should assume that goes off, and at one point or another, you might want to put in a property manager. Repairs, I put in at 10%, as well as CapEx. Again, these might not come up, and you might end up having all of this money at the end of the year as part of your cash flow. But until you build up a good reserve of a couple of thousand, you want to keep on chipping into that every single month. In the end, you get a calculation for your total operating expenses. So if your gross operating income was $1,350, and then you have your $633, you now have what's called NOI. The way I calculate the NOI is annual, so it's the 1620 minus the 760. Your NOI comes out as 8,600. That is the money, that's the revenue. I'm sorry, that's also not correct. That's the money that the property is throwing off, and you're going to be using that also to pay off the debt service. And in the end, that gives you your annual cash flow. I also put it here for monthly, just because I like it's sometimes it's easier to look at it from a monthly perspective. There is another couple of indicators here. There's the rent ratio, meaning what percentage of the cost is the rent. I have some conditional formatting here which I've set up here, that if that's above 1%, it shows up as green. The expense ratio, this seems a little low, so you might want to make sure that doesn't look fishy. I'd say anything below 45% or 55%, I'd start looking really carefully at why that's different. Debt coverage ratio is a calculation of how how many times your rent covers your mortgage payments, and then the gross rent multiplier is how many years will it take of your gross scheduled income to pay off your purchase price. These are all indicators that banks look at, so these are good things to make sure that you're aware of. You're going to get asked by your lender, or they're going to calculate that themselves, figuring out what it is that they want. It's usually 1.25, 1.3 that lenders want for this one. The gross rent multiplier is more for commercial properties, but it's not a bad thing to look at. What else have we got? Your cap rate is your cap rate's an indication really is an indication of how risky the property is, but it's also an indication of how many times how many times it's going to take in order to pull out your money. So if your NOI, meaning as an indicator of NOI, so how many, if you take the purchase price, or rather the NOI divided by your purchase price, you get the 9%. And your cash on cash is an indicator of your cash flow as opposed to your cash outlay. A lot of people compare that to interest rate you might get or returns you might get on other investments. It's not a bad rough comparison, although like I've said a lot of times before, I think it's a very shallow comparison, seeing as it doesn't take into account a whole bunch of other things that real estate does that other investment avenues don't allow, which includes the effect of leveraging and having someone else pay off your 75% of your loan. It doesn't take into account any of the tax advantages, and a bunch of other things. So that's basically my sheet. If you watch any of my videos, I catalog all of the deals I look at here with a couple of basic indicators that I can then look at and decide to filter, for instance, by cash on cash or by cash flow, and look a little deeper into the rest of the properties. That's about it for today. I'll be back tomorrow with more deals to analyze. If you have any questions, just drop a note into the comment field. That's it. See you tomorrow.